These are simple elements that repeat. What you're looking for is a run on liquidity, buy stops or sell stops. If you're bearish, you're looking for buy stops to be ran. Then a break in market structure, lower, a short-term low being broken. That's what it looks like right here. Short-term swing low. We have a candle high. I'm sorry, a candle higher to the left with its low here. Then you have the low of this candle, and the next candle's higher low than this one. So you have a swing low formed. You want to learn to trust going short when the market's going higher, and that feels scary at first. But once you start seeing this pattern form, it becomes easy to trust it. And in fact, you want to be doing that. You want to be selling short, expecting lower prices right when the candle's going up. And retail traders can't grasp that many times. It's just like, it goes against the logic because they think I got to have confirmation. All the books say I have to have confirmation. And that's somebody that's coming in late. That's someone that doesn't know how to read price. They can't really follow it. And usually they're the people that will trade short with additional sell stops. They'll put sell stops below the marketplace, and then that's the momentum entry for them. And it's kind of like a no-brainer. In fast markets, it works. But if you don't know what you're doing, you try to do that in a market that's consolidating or about to reverse, it hands you your backside. Okay, so if you're looking at this framework here, and we've taken the buy stops, we have our entry pattern here, what would you be looking for as a downside objective? Well, I'm going to teach you the liquidity matrix. Okay, and sounds pretty cool, sounds neat and all that, but watch what it is. This here is your range. This is the low of the day, and this is the high of the day thus far. So if we take that range and split it from the low to the high to get the midpoint, all of this can be determined by a simple 50 level on a Fibonacci. So you drag your fib from this high down to that low or vice versa and have your 50 level highlighted. Then anything above that 50 level, this is referred to from an algorithmic stance as a premium market. It means it's expensive. Now markets can stay in a premium for a while and not go to a discount, which would be below the 50 point. Okay, 50%, anything down here is a discount. If you're bearish, if you're ever going short, you want to look at the previous range. Where are you at inside that range? So when this formed here, that little fair value gap, once that formed, you're thinking, okay, we are in a premium, so algorithms will want to go to a discount. That's the opposing side of the marketplace. So if it's going short here, it's driving the market lower. What does that mean? The algorithm is going to start pricing lower. You can have all the buyers in the world come in. If the algorithm is in a sell program and it's going lower, it does not matter. It's going to reprice lower and lower and lower. And then what will happen is those buyers that may come in with a huge influx of volume, they're going to get crushed and they get squeezed. You ever hear that term? Oh, this is a bear squeeze. This is a bull squeeze. All that is an excuse for them not to know why the algorithm's doing what it's doing. That's it. That's all it is. It's an out. Okay. I'm telling you, this is what's really going on. So the market's moving from this premium high, this specific entry point, to a level below the 50 of this range, this low and this high. I want you to think about what below this level here, the 50 level, what is resting below here? Sell stops. So now think about the idea of someone like you and I that would see this ideal entry as a short. We have to sell to get in that short. How do we get out of that short? We got to buy it back or cover it by buying. Well, we're going to find willing sellers at a low price relative to this point here. They're willing already sitting down there with their sell stops right below that low. Now look closely. What else resides right near that low? Do you see it? Pause the video before I show it to you because it kind of ruins the experience. Because if you find it and I don't tell it, it feels good. Right there is that imbalance I mentioned. Okay, it's only one single candle passing up, and the previous candle's high and the next candle's low. That area right there is an imbalance. From this area here, it went down below the 50 level and attacked these sell stops and completely closed in this imbalance. So every point of this candle's high to this candle's low, that range with the candle only going up, that's a buy side imbalance. It has to have an equal delivery to be efficiently priced and booked by the algorithm. It goes down and completely closes it back in with down movement Notice the candle on this here, it opens and then trades down. So it fulfills its role of balancing the buy side offering, now the sell side offering. So that is an efficiently delivered price move. Precision elements from the entry here down to here. This repeats every single week. Every single week. Now, I want you to count the number of the handles in this move. Let's say you got in at, say you got in at 800, 14,800. It started to go down, you trust it. Okay, we're going to go short. Ideally, you want to enter as it goes into that, but it's going to take time for you to trust that. But let's say you got in at 14,800. If you got out down here, like I did, I exited as it went right to the top of that range, right here. This range here, that's the top of it. Once it went below that, that was it for me. That closed the trade. Is that 5 handles? Is that 10 handles? Is that 20 handles? Is that 30 handles? Is that 50 handles? No. It's over 100 and some. Now, let's assume for a moment that you get good at this, or I get the inclination that I want to go to some kind of a deep discount broker. And I go in and I do trades like this, and I'm putting on 15 to 25 full futures contracts. What do you think the results are going to be? Yep. So, not everything is going to be easy right away. And you're not going to be able to see these things happen just because you sit in front of the charts. You have to study and you have to practice. And by experience of looking at old moves and watching real price action as best as you can. If you can't watch it live, TradingView has a replay button where you can watch the candles kind of form, but they're a little stilted because it's not completely painting the candle. These are simple elements that repeat. What you're looking for is a run on liquidity. Buy stops or sell stops. If you're bearish, you're looking for buy stops to be ran. Then a break in market structure, lower, a short-term low being broken. That's what it looks like right here. Short-term swing low. We have a candle high. A candle higher to the left with its low here. Then you have the low of this candle, and the next candle's higher low than this one. So you have a swing low formed. If you have that, and then you have a break below that, if it happens that creates a gap like this, that's what you're looking for. When it trades up into that, you can go short. Or if you want to use sell stops, you can use a sell stop in this candle here and just let it trip you in and then use the high of that candle as your stop. That may be too wide for you, but I mentioned the logic around this is you're using a micro. Okay, micros aren't that big of a deal. It's not a lot of money. Okay, you're not risking a full futures leverage. It's very, very small. So if you're looking at these types of setups and you can find them forming repeatedly over and over and over again, and you study them, you're going to see that you don't need to get these little 5 handle moves, these little 10 handle moves. You can make a living doing that. Don't get me wrong. I'm not trying to say that people cannot be profitable and wildly profitable. But when you learn how to do something like this, and you're able to pull down this number of handles, and then you have sound money management, nothing compares to it, folks. These are the things that I use when you watched when I was on Twitter and I ran up the demo accounts really high. These are the types of setups I was using. I want you to look at this low down here, and I want you to look at this high up here. Okay, do you see how that is the biggest price swing on this entire chart? So between August 14th all the way to the present time in September, there has only been one major price swing higher and lower. So if we take a Fibonacci level, okay, and I'm only going to use Fibonacci to illustrate equilibrium, okay, because I first have to establish what equilibrium is. This is the largest price range, okay, or the market range that's presently being traded in. Now, what do I mean by present market range? This is the highest range we've seen, okay, in the last month or so. So if we look at this range, and I'm going to scroll back here so you can see it, there's nothing more significant than that except for this one back here, but we're going to primarily use this one because it has a very strong reaction. We can use these back here, Okay, and I'll do it for completeness sake later on in the video, but for now I want you to see we have a very strong impulsive move away. Then it comes back, retraces, then it have another strong impulsive move away and comes all the way up here to the high. Okay, when we say impulsive price move, or what we refer to as impulsive price swing going forward throughout this mentorship, that is the indication that there has been displacement. Now, displacement is where someone with a lot of money, okay, comes into the marketplace and they have a strong conviction to move price higher. We already know that price is going to be set by the central bank. So if they're letting price run this high, they're offering at a higher price. As long as there's buyers coming in, they're going to keep offering that price there. As long as they keep finding buyers, as they keep raising price up, they'll keep expanding price higher, 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 until there is no longer any interest for them to pair up orders with participants. Okay, other open interest in the marketplace. So they'll allow price to retrace a little bit until they can get more buy stops above the marketplace. It is not a buyer, 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 buyer market, and they keep stretching price. They have already bought down here, and then they're allowing price to be offered to the marketplace at higher prices. Okay, and as that happens, all they're doing is selling off their positions they established at a lower low. Okay, from here, the banks are long positions in here. They accumulate long positions. Once they accumulate a position, they allow price to go higher. Okay, once that price goes higher, 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 it keeps going higher until their position is funded and they no longer want any more position held. So they're going to be looking for liquidation areas where they know that there's going to be willing participants to buy. That's going to be above this old high back here. Why would they want to take price above that old high here? Because there's going to be buy stops on a fund level. That means big money managed funds will have stop loss orders right above that high. And I'm going to go into details in this mentorship about where stops are, how to pick out institutional funds levels where their stops are at, where high target big money moves are going to occur. All those things will be taught to you, but for now I just want to start you very small, because then there's a lot of folks that just started with this mentorship and they've never really been through the complete library of my concepts, or they haven't really exposed themselves to technical analysis. So all this seems Greek to them. And I don't mean that to offend anybody that may be Greek, but it's an expression in the States. It means it's alien to them. But the first thing I want you to look for in price is you want to see impulsive price swings. Okay, and since we're primarily looking for discount markets, okay, in relative terms to equilibrium, we first have to understand what an impulse price swing is. So let me take the fib off real quick and go back to that price leg right here. Let me take all this stuff off over here. Okay, so we have one big strong impulsive price swing right here. It comes off this low and rallies up. We don't need to know what caused the buy down here. It's not interesting at all to me. I don't care. Okay, we don't know this price link is going to start until, I'm sorry, we don't know this price leg is here, okay, until it forms. So I'm giving you a perspective. Studying in hindsight, the low to this high in here, okay, that rally up or that impulsive price swing, we only require price to start coming down off of that, and it takes at least 4 candles. No matter what time frame you're on, you need 4 candles, okay, from when the market makes a low and starts rallying up. What you're going to look for is, once you see a high form, let me zoom in. Once you see a high form, you need 4 candles. Why 4 candles? You need to have 1 candle to the left, 1 candle in the center, the most highest one, then a lower candle to the right. That's a swing high, and then you got to see price go lower. When that happens, you start waiting for price to retrace back to equilibrium. Now, what is equilibrium? Equilibrium is a midway point of a price move. Okay, so we're measuring the high from this low. You take your fib, you draw it up to the low, and you drop it. Equilibrium is over here. Let me scrunch this up a little bit more.
Okay, so we have this price leg up. So impulsive price swing goes higher. As soon as we get 3 candles, then and only then will we start watching for price to come down to the equilibrium price point, and that is basically the Fibonacci level 50%. Okay, we're looking for price to come down to that level, and as soon as it comes back to that level, and we're on a daily chart, we go down into a lower time frame and we hunt buying opportunities. Now, I'm not teaching you buying entry signals, okay? I'm giving you context of how to discern when the market goes to discount and when it's at a premium. We have a price swing that moves from a low aggressively up. We don't do anything until we start seeing a down move, and it has to happen after 3 candles, basically making a swing high. Now, a swing high looks like this. Okay, you can see it has a high and a candle to the left that's lower and a candle to the right that's lower. That's a swing high. And then once that swing high forms, we're waiting for the 4th candle, okay, to start coming lower. In other words, we're looking for 4 candles to start turning around. When that happens, okay, it gives you, now you're allowed to start looking for the market to come down into equilibrium. That means the 50% level. Okay, once you're on a 50% level and you're in a higher time frame, and we start everything at a daily chart, at the daily chart, we know now that between the low here and the high here, the market now has gone back to equilibrium. So it's at fair value, or at fair market value. If you get something at fair market value, obviously you're not paying a premium, but you're not really getting a discount either. But it's still a neutral to bullish condition. That means you're not buying at an inflated price. So this time period right here, the market is offering an opportunity to be long. I'm not going down to lower time frames today. I'm not going to teach you that today. Only thing I'm giving you right now is developing context around the daily institutional price levels that are arrived at on the daily chart. And all you're looking for is impulsive price swings first, letting price settle back down into equilibrium, and then we discern what we're going to do when we get to that level. As you can see, without going into lower time frames, the price does rally again. Where does it rally back up to? Its old institutional order flow reference point, which is an old high back here. So it goes right above that previous high. See that? Now the market trades off again and goes lower. So we have now a new range. We have to now put the Fibonacci on this high, keeping it off this same low. Now, why did I do that? Because this price low has not been violated. It only retraced down to here. It rallied up again. Then we wait for 3 candles. The high candle to the left, there's a lower one. To the right, there's a lower one. This is probably a Sunday, and even still, this is one here. Either way, you don't want to count Sundays, by the way. MT4 on Forex LTD does give you the Sunday candle, so you got to factor that out. Don't count Sunday's candle because it's a non-event. So that's probably going to end up becoming this candle here. Once you get the down candle here that the market has in fact turned, it's starting to go lower. Notice what's happening here. We're not rushing. We don't need to catch the high. Okay, it gives us all kinds of time to wait and plan and build an idea about what it is specifically we're going to do when price gets to equilibrium. Price drops down a little bit more, then it goes up. What do we do the whole time this is happening? Nothing. We're not doing anything. This is a higher time frame principle. Most of you are all begging for a higher time frame principle to trade with. This is the beginning building blocks to that. Okay, market trades lower, lower. What do we do here? Nothing. We're not doing anything here yet. Okay, nothing. Trading lower, 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 lower. All of a sudden, boom, it hits equilibrium over here. Now we can start studying price. We want to study price. On the lower time frames, we'll look for entries, but I'm not teaching you entry signals here. I'm giving you context. As soon as we get to equilibrium, we are now at fair market value, so the market is permitted to be bought. Okay, at the banking level, they will be able to buy at these levels because they're not at a premium-based market. The levels that are trading at this level here are at fair market value. Now, banks are just like anyone else. If you go to the grocery store and you see steaks for $10 I don't even know what they cost because my wife does all the shopping. If a steak costs $10 at the market, and it drops down to $8.50 a stake, that's probably, a discount. And it may not be that price, I don't know, but for the sake of analogy, we're using it. That means that we are now at a discount. Anything below equilibrium is now a discount market. When markets go below equilibrium, they do not spend much time below equilibrium, and there's usually a very dynamic price move away from that, especially if the context behind the marketplace is bullish. Now, looking at this framework we have here, we had an impulsive price swing here, a tiny little retracement, came back to equilibrium, rallied one more time, took out the high over here, and then sold off. Okay, went back down into equilibrium again and went to a discount below 50% of the impulse price swing. That is now at a discount. So the market on the banking perspective is that this now is at a discount. It is allowed to be bought. Now, you just don't go indiscriminately in there trying to buy it just because it goes back to 50% or less. That's not enough. You got to have more information. But for now, I just want to give you, when we have a bullish scenario for a marketplace, okay, if we think a pair is bullish, we look for impulsive price swings on the daily chart to frame higher time frame ideas. There's other trades that you can take in lower time frames in between these, but for now, I want you primarily focused on just this, because it'll give you all the things that you've probably been lacking with higher time frame ideas and the beginning blocks of directional bias.